All right, listen. Gold is doing something that should have every investor paying attention. As I'm recording this, gold is sitting around $5,048 an ounce. And the big story isn't the little daily wiggle, down about 0.2%. The story is that gold is still holding that $5,000 line. Because once a market starts treating a big round number like a floor, it changes behavior. It changes how traders think. It changes how institutions position. And it changes what happens next if that floor cracks. So in this video, I'm going to explain why that 5,000 level matters way more than most people realize, what it tells me about the next move, and what I'm personally watching next, especially with silver getting hit harder at the same time. Now, this isn't just normal market behavior. Three critical events just collided. First, gold is trading like it's in what traders call price discovery. That's a fancy way of saying the market is exploring new territory where there isn't much historical memory. When prices get this high, you don't have the same old reference points where everyone remembers buying or selling before. So instead, the market anchors to psychology, big round numbers. And 5,000 is the biggest psychological number in this entire move. When gold gets above a level like that and then comes back down, you usually see one of two things. Either buyers step in and defend it fast, or the market slices through it and you get a cascade, because everyone who was waiting for a dip suddenly realizes the dip doesn't stop. And right now, gold is acting like that 5,000 zone is being defended. Second, the volatility story has shifted from inflation panic to positioning and leverage. That matters because when the driver is leverage, you can get these sharp, violent swings that feel irrational in the moment. It's not people calmly deciding gold is worth less. It's people getting forced out. It's margin. It's risk desks. It's sell what you can instead of sell what you want. So even on a day where gold looks calm, down a hair, what's underneath can still be unstable. Third, the gold market doesn't trade in isolation anymore. It's getting pulled around by global flows, not just Americans buying coins, not just ETFs, not just futures traders in New York. We're talking global demand waves, regions and institutions piling in, rotating out, and sometimes stampeding at the same time. That's why you can't look at one headline and think you've solved it. This is a system, and systems don't break at random. They break at pressure points. And 5,000 is the biggest pressure point on the board. Now here's what Wall Street analysts aren't discussing. Smart money moved before the crowd noticed. Let me start with the institutional behavior first, because this is the part that tells you whether a move has legs or whether it's just hype. When gold is above 5,000, you would expect demand to cool off. You'd expect buyers to hesitate. You'd expect people to say, I missed it. But instead, we're seeing signals that real money is still participating. One of the cleanest examples is what's happening in India through gold ETFs, flows pushing into gold at a pace strong enough to set records. And I want you to think about what that means psychologically. If regular investors were truly done, if this was just a top, if this was just a blow-off, you wouldn't see that kind of continued participation. People don't normally chase records if they think the party is over. They pull back, they wait, they get cautious. So when you see heavy interest continuing while prices are still elevated, that tells you something simple. A lot of people do not trust the alternative. They may not say it that way. They'll talk about diversification, they'll talk about uncertainty, they'll talk about geopolitical risk, but underneath it, the emotion is the same. They want something real. Now, does that guarantee gold goes higher tomorrow? No, it doesn't. Markets can punish everyone for longer than you think. But flows tell you what people are doing with their money, not what they're saying in interviews. And when money keeps leaning into gold at these levels, you have to respect that. Next, the technical picture, without assuming you're looking at any charts. When I analyze gold in a situation like this, I don't overcomplicate it. I'm watching one thing. Does the market treat 5,000 like a floor or like a ceiling? If gold can repeatedly dip toward 5,000 and then bounce, fast, that's a sign of real demand sitting underneath. It's like a trampoline effect. People are waiting, they have bids in, they want exposure. They're not trying to time the perfect bottom, they're just trying to get in. But if gold starts dipping below 5,000 and then failing to reclaim it quickly, that's where things get dangerous. Because then 5,000 flips from a support into resistance. In plain English, what used to be the floor becomes the ceiling, and that's when sellers start getting confident. That's when people who bought above 5,000 start thinking, oh no, am I trapped? And that's when you can get that ugly move where it drops further than seems reasonable, simply because the psychology shifts. So here's the real-time reality. Gold being at roughly 5,048 while still hovering above 5,000 tells me the market hasn't broken the narrative. Not yet. And that's why this matters, because the most violent moves don't happen at random prices. They happen at levels everybody can see in their head without any chart at all. 5,000 is one of those levels. Now let's connect this to fundamentals, the real supply and demand picture. When people talk about gold, they usually make it sound like it's only about inflation. That's incomplete. Gold is also about trust. Trust in currencies, trust in government debt, trust in stability, trust that when you save money today, it will still represent real purchasing power later. And when trust gets shaky, whether because of deficit spending, geopolitical fractures, or financial system stress, gold tends to get bid, even if the inflation numbers aren't screaming. That's why you can see gold hold up while other things wobble. And it's also why you can see gold stay firm even when the day-to-day headlines look meh. Because the buyer isn't a day trader. The buyer is a long-term allocator thinking in years. Now let's talk about the weird part, silver. Silver is around 81.64 at the same moment gold is holding above 5,000. And silver is down almost 2% on the day while gold is barely down at all. That tells you something important about the market's mood. When fear is rising, gold often behaves like money. Silver often behaves like a hybrid, part money, part industrial metal, and part speculation. So in shaky, forced liquidation environments, silver can get hit harder. It's thinner, it's more volatile, it's more emotional. And if traders are deleveraging, silver is often where they take the axe first. So the fact that gold is holding a major psychological floor, while silver is getting slapped around, tells me we're not in a calm, rational pricing environment. We're in a positioning environment. We're in a who's forced to do what environment. And that's exactly where support levels become life or death. Now, let's zoom out with a historical parallel, because we have seen this exact pattern before. History is repeating itself. Back in 2020, during the global panic phase, you had a period where gold held up better than silver, until silver suddenly caught fire. In that cycle, gold was acting like the trust trade, and silver was acting like the catch-up trade. Silver didn't move smoothly, it moved violently. It would drop hard, shake people out, make it feel like the move was over, and then explode higher in a way that made anyone who hesitated feel sick. The pattern was psychological. First, gold attracts the cautious money, the money that wants safety, that wants stability, that wants a hedge. Then, once confidence builds and the narrative hardens, silver becomes the leveraged expression of the same idea. Because people look at gold and say, I missed it. Then they look at silver and say, this is the cheaper one, and that's where the stampede can happen. But in the middle, during the messy part, you get these dips in silver that feel like betrayal, like the market is punishing you personally. That's why I'm emphasizing gold's behavior at 5,000. Because gold holding the line often sets the stage for what silver does next. Not always immediately. Sometimes there's a lag. Sometimes silver stays weak longer than you think it should. But historically, when gold establishes a new normal above a big threshold, silver eventually has to reprice to match the new environment. Again, not financial advice, not a guarantee, just the way market psychology tends to play out. Now let's make this personal, because this isn't just abstract. Here's what this means for your portfolio. If you're a regular person holding a mix of stocks and bonds, something like a 60-40, moves like this in metals are not random entertainment. They're signals. They're the smoke alarm. Gold doesn't need to soar every day to be useful. What you're watching is gold refusing to collapse when the system is sending mixed signals. And if you own any gold exposure, physical, ETF, miners, whatever, it's not about bragging rights. It's about stability. Now let me give you a simple dollar example. If you had 10 ounces of gold exposure, just 10, and gold is around 5,048, that's about $50,000 of gold exposure. A move of just 2% in gold from here isn't some tiny number. 2% on 50,000 is about $1,000. A move of 10% is about $5,000. And in a market that's already shown it can swing fast, those moves can happen quicker than people expect, especially if that 5,000 line becomes a magnet for big orders. Now on silver, the volatility is even more personal. If you had, say, 1,000 ounces of silver exposure, a number a lot of stackers and long-term holders can relate to, silver at about 81.64 means your position is about $81,600. A one-day move of 2% is over $1,600. That's why people feel these days in their stomach. And it's why holding the line matters psychologically. If gold breaks 5,000, silver can get ugly fast. But if gold holds and starts pushing higher again, silver can reverse in a way that feels violent in the other direction. So the question isn't whether we get volatility. The math is clear. Volatility is already here. The real question is, are you positioned for what comes next without letting the headlines whip you around? Look, the question isn't whether this continues or we see more volatility. The data is clear. The real question is, Are you positioned for what comes next? In every previous crisis and every previous regime change, hard assets preserved purchasing power, while paper promises quietly eroded. Right now, gold sits around 5,048. That 5,000 level is the battlefield, and the next week determines whether this was consolidation before another push or the start of a deeper shakeout. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the fundamentals and the psychology speak for themselves. All right, before you go, 3 quick things. 1, drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think gold is headed by the end of the month? Above 5,200 or back under 5,000? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3, next video drops soon. I'm covering the one indicator that tends to flash right before these big psychological levels either break or launch. And if it's flashing again, you're going to want to hear it. See you there.